and welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, how are you doing today?
Oh, I am doing awesome. New year, new day. Let's keep it going.
I know, it's fantastic, right? We're finally in the new year. I know we were excited to leave 2020 behind.
Oh my gosh, don't come back. Yes.
I know. So let's talk a little bit about that, because obviously cascading into 2021, a lot of people made health resolutions, fitness resolutions, taking better care of themselves, eating healthier, getting more sleep, drinking more water, whatever that may be.
Right.
What about financial resolutions? Are people making financial resolutions? Have you heard of any in the office?
Well, I think it's super important for people to do that. Yeah, absolutely. It's funny, we're booking up pretty quickly here. You know, the nice thing about our TV show is that it's really allowed our existing clients who watch it to say, hey, you know what, we need to talk more about that. Let's go ahead. And it just keeps people on these consistent, you know, schedules here. You know, it's the whole purpose of the TV show is to stimulate a conversation, right? To get people to think about it. And when it comes to New Year's resolutions, especially when it comes to financial things, I think the first and foremost is when it comes to understanding what's important in this year, number one is there's obviously a big difference between people that are doing well and people that aren't. And what I mean by that is that, you know, some of us were affected dramatically and drastically by COVID and the shutdowns and everything else. And, you know, others of us have done very well. You know, I feel very blessed to be in a position that, you know, we grew during a time where everybody else seemed to have had a really tough time. And, you know, my partner and I came to a conclusion that we really do want to give back. We want to make sure that those that are less fortunate than us, you know, we can help. And so what we did is we set up a process here to be able to give back. And what we chose as our charity was the St. Mary's Food Bank. St. Mary's Food Bank is one of the oldest food banks in the country, based here in Phoenix. You know, for every $1 you give, feeds 7 people.
That's
so
fantastic.
It's incredible. It's super incredible. So what we've done is, if you go to www.apsitaxes.com, that's our website, there will be a little link on there that if you click on that, we will match dollar for dollar every contribution that you make up to $20,000. So it's really important. We can feed a ton of people. We've benefited during a tough time, and we don't want to be the robber barons of this economy. We want to give back as well. And I know there's going to be some other charities that we look at as well. But you know, schools have been impacted dramatically as well. And I know, you know, we've done a few things kind of that we haven't talked about on air. But this is something we want to get, you know, the audience involved in as well. So if they do that, it'd be great. The other thing is to get a second opinion. People need to make sure that, you know, that they seek advice, right? People know they aren't super happy with what they currently have. Their advisors don't call them, or they're not performing the way that they hear they should be. Well, what you need to do is get a second opinion, and we'd be glad to provide that for you at no cost. It's completely complimentary. There's no pressure. But if you get that second opinion, what we can do is take a look at what kind of risks you're taking, what kind of fees you're paying. We'll look at all of that stuff. And also, you know, as a third item, to consider taxes, meaning, is there a tax plan in place when it comes to your financial plan? And, you know, what we're seeing oftentimes is that financial advisors, you know, when you go to them and say, hey, we need to do some tax planning, or what do you think about Roth conversion? They'll say, hey, you know, we like Roth. And, you know, you'll say, well, how much should we put into it, or how much should we convert? You know what? You should talk to your tax advisors what you get. Well, then you go to your tax person, and your tax person says, go talk to your financial advisor. And so the right hand never knows what the left hand's doing. And that's a big, big, big problem. So in my opinion, you need to consider taxes. And that's one of the cool things that we do.
And that's a great point that you bring up, Stewart, because so often we've talked about the importance of a holistic retirement plan, and a lot of times people plan to move past taxes, if you will. They don't put a proper amount of time in planning for taxes, but you focus on that to help people, and it's so different. Let's talk about the difference between tax preparation and tax planning.
Sure. Well, tax preparation is just what happens when you go into your local, whether it's a CPA, an enrolled agent, or a certified tax preparer. They're probably doing an okay job at preparing the taxes. But remember, what happens during tax season? What you're doing is you're squeezing in, all of these people into this very brief period of time. And so these tax people, these CPAs, enrolled agents, you got to feel for them during tax season, because these people are working 10, 12, 15-hour days. And remember, if you're doing your taxes during tax season, the issue is going to be that they are just in a rush. I mean, they're doing, like, even at our office, we do about 700 tax returns. Now, we're a little different because we're a bit overstaffed for taxes, and we do it intentionally because of the planning, aspect of what we do. But if you're trying to get tax advice when these people are just, surviving as zombies during this crazy period of time, it's darn near impossible to create a plan, right?
Sure.
You'll get some nice answers and so forth. The way that we do taxes it's a little bit different. It's a and it's not for everybody, and that's okay. A lot of people are used to going into their local office and they come in with their paperwork and they leave with their tax return done. It's not what we do. What we do is basically you meet with one of our enrolled agents or CPAs. They do an interview process. They ask you all the questions necessary, and then the preparation begins. And so you don't walk away with the tax return that day. But our method is different because once it's being prepared, and then once it's prepared, it's then reviewed by a second CPA. Now, remember, these people, the one dirty secret about taxes is there's tons and tons and tons of mistakes being made. Now, people, may vomit at hearing me say that because, it is a reality. But, we try to limit that to, and do we make mistakes? Absolutely. If someone tells you they're not telling you the truth. But we have such a detailed process that those things are so few and far between. We have just multiple layers of people looking at it, at the tax returns to make sure that there are no mistakes. We don't want to see a client audited because of our mistake, right? So we take every measure we can to make sure it's done properly and cleanly.
Absolutely. And I want to ask you about some of the common mistakes, Stewart, but I think it's a great time for us to open up the phone lines before I do that. Would you agree?
Absolutely.
Okay. To the viewers at home, the phone lines are now open. The number to call is 833-652-7829. What Stewart is offering you today is a complimentary consultation, a portfolio review. Let him take a look at what you currently have in place. Is it the right plan for you? Does it need to be tweaked? Or perhaps you need to have a plan put together from scratch. Stewart and Judd can help you with that as well. Again, it's a complimentary consultation. All you have to do is pick up the phone and call. The number is 833-652-7829. When we come back, I'm going to have some more questions for Stewart about proper tax planning, so please stay tuned.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. And Stewart, of course, is the co-founder of Asset Preservation Tax and Retirement Services. Stewart, I'd love to dive in a little bit more about actually the tax planning part, if you will. And I know that we talked a little bit about mistakes, but let me ask you, what are some of the common mistakes that you're seeing with tax planning, if you will?
Well, what we're seeing when it comes to tax planning is that there is none being done, right? So when I was talking about mistakes earlier, I'm talking about clerical errors of, or not getting the proper information. But what we see, and I would consider it a mistake not to look at taxes when it comes to tax planning, right? So what we're seeing is that, I had a client the other day that came in and he had these massive capital losses. And a capital loss is basically when let's say you invest in a stock, say you pay $100,000 for these stocks, it loses half of its value, $50,000. Well, you get to carry forward that loss and deduct it against future gains. Now, if you are deducting, or if you have these losses that are harvested, and we call those carry forward capital losses, if you have those harvested there and you have ordinary income, you can only use $3,000 a year of that capital loss carry forward against ordinary income. Now you can offset it dollar for dollar as much as you want if it's against a long-term capital gain. But the problem is most people don't consider that. I had a great client. I love this guy. He was phenomenal. Genius businessman. He and his wife, both brilliant people. But he was never taught how to properly use it. He had about a $2 million carry forward capital loss. And he just said to me basically, hey, Stewart, I need a dividend plan, right? And if we're not talking dividends, we're not doing business. And I just said, well, that would be a mistake, and I don't know that I'm interested if that's what you're looking for. And he was shocked, right? This guy had millions of dollars, and he's used to, he thought I was going to beg for the business, and I like the guy, and I want to do business with him. But I said, there's a tremendous mistake you're making. And one of those mistakes is that we're not considering these capital losses. He's like, well, but I can only use $3,000 a year. I said, yeah, because you're chasing dividends. What if we look at a growth strategy that we're looking to harvest long-term capital gains? Whether it's being used as a growth strategy or dividends, if you can receive the same amount of income from long-term gains or dividends, what is the difference to you? One of them we can get for tax-free. The other ones you have to pay, tax on. And he was just surprised. I mean, he's like shell-shocked, right? He's like, well, how come my advisor didn't talk about that? I don't know. My question to him was, well, when he asked to look at your taxes and tell you should go on to a capital gains, harvesting strategy, why didn't you listen to him? And of course his answer was, well, he never said that. Of course, he didn't say that, right? They don't look. If an advisor isn't looking at your tax returns, it's just lazy. I mean, that's all it is, But in their defense, in the individual advisor's defense, a lot of their companies prohibit them from making any sort of, tax-related advice, suggestions. So oftentimes they're prohibited by their firm because they don't want the liability of bad tax advice. Well, it's precisely why we have a tax staff on board year-round to be able to give that advice.
And I love that, Stuart, because it brings everything into one holistic piece, if you will. So you can look at the entire retirement plan and factor in the most important, or one of the most important, I should say, which would be taxes.
Sure.
It makes sense.
Absolutely. So a big part of what we saw at the end of last year, were people that are trying to harvest their gains, because listen, I have no clue what direction the company's going, or the country's going in terms of, tax policy, right? If we look at the campaign promises, of Biden, then, taxes are going to increase, right? They're getting rid of the Trump tax cuts. But just remember, those Trump tax cuts affected people all the way down to the 12% tax bracket. That 12% bracket used to be 15%. That 22% bracket was 25%, and that 24% used to be 28%. So people at almost every bracket, except for the 10% bracket, were given a substantial, tax break. And so one of the things that they were talking about is that basically capital gains only benefit the wealthy, is what the argument is. Well, we saw a massive rush at the end of last year, to start dumping not only real estate property, but, long-term individual stock positions, because they want to make sure that they can pay a 15% or 20% capital gain rather than the 40+% that we're hearing it's going to switch to. Is it going to happen? I have no clue. I won't know until the law passes, right? It all depends on, several factors, but what we know is what we know the environment is right now. And it makes sense to make a tax plan.
Absolutely. And Stewart, would you recommend a Roth conversion be a part of a tax plan for someone?
Absolutely. So Roth conversion or Roth contribution is a huge part of our business and our business success. The whole value of a Roth conversion can only be measured by a cash flow analysis. And what we do in that regard is we basically introduce, the retirement funds that you have. We look at converting it over 1 year, 2 years, 5 years, 10 years, and then we cash flow out the end result. Oftentimes, people don't realize that in a normal IRA or 401k or thrift savings plan or 457B, that when they die, they're going to pass those assets taxable to the kids, right? And those taxes don't go away. In a Roth, it all grows tax-free. The problem is you have to pay the tax bill now. So do you want to pay the tax bill now, or do you want to pay it later, right?
I'd say probably now, right, when taxes are low?
Well, we know where they are now.
Yeah.
I mean, hopefully the tax laws aren't going to be retroactive to this year. So we don't know if the taxes increase. Where we do believe the proposals are going to go is that we do believe capital gains are going to increase. And remember, along with capital gains is also something we call step up in basis. Now, what step up in basis is when you, let's say you buy a house for $100 or a stock at $100,000. And it appreciates in value to $300,000. Well, there's $200,000 of capital gains in there. Now, under the current environment, when you sell it, assuming you're under $400,000 of income or so, you're going to pay about a 15% capital gain, long-term capital gain on that if you owned it over a year. But if you hold it and then you pass it on to your kids, they acquire it at what we call current market value. And what that means is they basically get a step up in value. So it wipes out all the capital gains. So a lot of people, when they talked about, for example, Trump's tax return, they were like, well, how the heck does this guy only pay $750? If that's true, I don't know, I haven't seen the tax returns, but let's assume it is, right? If it's true. Well, first of all, the number one answer, the reason he did that and the reason Mitt Romney only paid 15% tax is for one reason. They have tax planners. That's it.
Yeah.
Right? They have to have a plan, and those guys do. But here's how it works. Here's how the fundamentals of it work. Basically, what happens is they go and they buy a house, for example, and they rent it out for 20 years. And they get what's called depreciation on it. And what depreciation is basically the, I think we just had a light blowout. That was awesome. So, do I still look good here? No.
You look great.
But no, what it is basically, is that when they depreciate the property value, they depreciate it in a way that offsets the rental income. So say you buy a $100,000 house, you're receiving X amount of dollars in rent. Well, your depreciation generally offset that. So you don't normally pay a ton of taxes on rental income. But after 20 years, that depreciation is completely gone, right? Well, once it's completely gone, then they do what's called a 1031 exchange, and they move the house to an apartment building, or that apartment building to a strip mall, that strip mall to a skyscraper, and there's never a capital gain paid on that. Yet you're continuing to depreciate your income and not paying tax on the income. When you die, remember, step up in basis, you basically pass it to your kids at the current market value, so there's never a capital gain being paid. And that's the argument to be made against what we call step up in basis. Currently, it exists. I don't know if it's going to go away, but it's really important to plan around it.
Absolutely. Thank you, Stewart. This is the perfect time for us to reopen the phone lines. Would you agree?
Absolutely.
To the viewers at home, the phone lines are once again now open. That number to call is 833-652-7829. What Stewart is offering you today is a complimentary consultation, a portfolio review, if you will. Let him take a look at what you currently have in place. Is it the right retirement plan for you? Is it going to weather any storm? Stewart and Judd can make sure that you are in the proper plan so that your retirement is stress-free and peaceful. Again, it's a complimentary consultation, and all you have to do today is pick up the phone and call 833-652-7829. We'll be right back after this very short commercial break.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis, and Stewart is co-founder of Asset Preservation Tax and Retirement Services. Stewart, a great show that we're having today, talking again about the importance of proper retirement planning and tax planning. Let me ask you a little bit about ordinary income. Can you explain to the viewing audience what that is?
Sure. Ordinary income is income that's derived from either earnings at work or interest off of your money. For example, if you pull money out of an IRA, or if you have money that you earn from your earnings, those are what we call ordinary income. The way that we would compare those is to look at dividends, for example. Dividends are taxed differently if they're qualified dividends. And remember, other kind of income, capital gains income, like we talked about before, right? Those are taxed at different rates. So ordinary income is what most of us see from earnings at work, or interest off of our money, or tax-deferred annuities, or IRAs.
Okay.
Yeah.
All right. Thank you, Stewart. What about marginal versus effective tax rates? What are the difference between the two?
Yeah, so I think there's a lot of confusion when it comes to brackets and how it works. I mean, I think a lot of times people are so concerned about jumping into the next tax bracket that they don't understand the impact of what it's actually doing. So let's just say that you're at the 22% tax bracket, and you have $1 that goes over that, into the 24% tax bracket. Mm-hmm. Well, that doesn't mean you're paying 24% on everything. You're only paying 24% on that $1 that exceeds the threshold. So if you're, in the 12% tax bracket, the way we like to look at it, I'll start over here, is the way we like to look at it basically is that going from the 10 to 12% bracket is what we call a small jump. 12 to 22% is a big jump. 22 to 24 is a small jump. 24 to 32 is a big jump. Yeah. So we try, if possible, to avoid those big jumps, especially when it comes to Roth conversions or any sort of realizing gains and so forth. But it's important to know that, to really play within that. But the way a marginal bracket works is that it's once you cross that income threshold, you jump up to the next bracket. That next bracket that you're in is your marginal rate. That's your next dollar taxed rate. Now, what the effective tax rate is basically a weighted average of all of your taxes together. So if you are, let's say you have an effective tax rate of, 18%. Well, there is no 18% tax bracket, is there? Right?
Mm-hmm.
There's a 12 and there's a 22. So what that means is typically that you're in the 22% or 24% bracket, but most of your money is in that 10 or 12% bracket. So it's a weighted average of where you actually fall inside those brackets. The other thing to look at is capital gains. Capital gains, if you have under $400,000 or so in total income, capital gains is at 15% currently.
Yeah.
If you have above that, it's at 20%. Now, we don't know what's going to happen, like I said earlier, about the new tax laws that are going to occur, but those numbers could go up into the 40s is what we're hearing. So what we're seeing is a lot of people that are dumping off capital assets just in case it rises, because we don't know if it's going to be a retroactive tax law. We're not doing any of that now. I don't suggest it now. I think we wait to see what's going on with the tax laws. We always wait till November and December to do that sort of analysis. We suggest you do the same thing, so you don't go and make a tax move today in January, February, March, and then in July a new tax law passes that makes it retroactive. Just like with Bill Clinton, there was a retroactive tax hike. We don't know whether or not that's going to occur.
Okay. Stewart, we have about a minute and a half left of the show today. What kind of advice can you give the viewing audience in our last final moments together?
The one piece of advice I would leave you with today is to make sure you look at the whole picture. The one thing that we do at Asset Preservation is we don't leave any stone unturned. We want to make sure that we are looking at not only the risk that you're taking, but we do want to look at taxes. We've talked a lot about taxes today. We want to take a look at how much capital gains do you have deferred, how much you can realize tax-free. Do you have any offsetting capital losses? We want to take a look at the whole picture. And what I would suggest moving into this new year here is that you get that second opinion. If you just shoot us a call, if you call us at 833-652-7829, we would be glad to give you a second opinion. You would be meeting with either Judd or myself. We're the two partners at Asset Preservation. We're not going to pass you off to a secondary advisor, no junior advisors here. We'd be glad to help. Just give us a call.
And Stewart, people really appreciate the fact that when they are coming in, they're meeting with you and they're meeting with Judd, one of the two. It's not going to be someone else. And I've heard that before as well. So thank you so much for all of your time today. Another great show. To the viewers at home, thank you for spending time with us again this week. We know you have a lot of questions about how to plan your perfect retirement. Stewart and Judd have the answers for you. Again, the number to call is 833-652-7829. We'll see you back here next week. But in the meantime, be safe, be happy, be blessed. Thank you again.